Certainly, this is the beginning of the end, if you like, of fiat currencies. I have no doubt about that whatsoever. And the thing that is so important in this is to understand why interest rates are going to rise and why interest rates are going to undermine financial assets, and why, by continuing to rise, they will also undermine physical assets. And we're talking about everything from residential property to the values of businesses and so on and so forth.
This week's specials with Miles Franklin Precious Metal Investments. Type 2 American Silver Eagles for only $7.75 over spot, and 2-ounce mother and baby platypus coins from the Perth Mint for only $3.75 over spot per ounce. Call us at 1-888-81-LIBERTY. That's 1-888-815-4237.
Welcome back to Liberty and Finance. We have a returning guest who is widely anticipated by our viewers. Whenever we don't get you on, Alasdair, more often than every few weeks, I get a hard time from it. Our subscribers saying, let's get this guy back on. That we look to you for insight into forward-looking research on what things are doing, specifically around the credit system, the banking system, the fiat currency system. People are sensing, perhaps quite accurately, that there are existential threats to their future financial livelihood and well-being that are in the works, and people are wondering, how do they protect themselves? So thank you for joining us here again this Thursday, October 7th, 2021 on Liberty and Finance.
My pleasure, DK.
You've spoken with us many times in the past about the impending risk to the systemic risk to the credit system, the banking system, the fiat currency system. We are seeing that right now playing out in the U.S., a big problem that you've written about just recently in government funding. We've seemed to be struggling to even pass a debt ceiling resolution. They can't seem to muster more than 30 days of wiggle room in granting us the ability to move forward and have our government stay in operation, that sort of thing, because we've hit the debt ceiling once again, whatever that means. Can you break it down into why you think that's important, what you're looking at, what it means to you, and what it should mean to all of us in terms of our financial lives going forward?
Yes, sure. I mean, the debt negotiations, there's nothing new in this. I think it's happened 100 times before. The debt ceiling always gets raised. And whether it gets raised temporarily or whether they kick it into the long grass until a later date, doesn't make any difference. It gets raised. And so let us assume that it will be raised. We've got the start of a new fiscal year from October the 1st. And what I would be looking for is to see how that is going to be funded. The first problem is estimating how much funding will be required. And I reckon that the ballpark figure that we should be looking at is around about $3 trillion budget deficit. That's exactly what it was last time. If you look at the office, the sort of the Congressional Budget Office estimates and so on and so forth, they think it's going to come down. I don't think it's going to come down. I think the reason it won't come down is that the optimistic forecasts from various government sources assume a level of economic growth that is faltering. They've always been optimistic in the past about this as well. So on that basis, if we just say at least $3 trillion of funding has got to be raised. So the question then arises, where is it going to come from? And basically, there are three sources. The first is the domestic economy, the private sector, private individuals in the non-bank sector, and also the banking sector. Now, the banks have a problem in that they don't really have an enormous amount of balance sheet capacity. So the ability of banks to take on debt onto their own balance sheets and, in effect, expand bank credit, admittedly in the form of bond purchases, is limited. Individuals are being encouraged to spend rather than save. So that's going in completely the wrong direction. And if you look at the last 10 years, in fact, the funding from the private sector in America has been roughly, I think it's 57% of the total. And that has been unchanged the whole way through. So the idea that there's suddenly going to be a leap forward, if you like, in that, I think we can dismiss. Another section of it is foreign buyers. While you're running an enormous trade deficit, obviously foreigners are in receipt of dollars, which they either sell or hold on to them. In the past, they've held on to them, so much so that they've now accumulated a total value of cash, short-term instruments, and financial securities totaling just under $33 trillion. And this is an enormous amount. And to put it into some sort of context, that's roughly 1.5 times US GDP. Will they continue to support the US government by holding on to dollars? Well, the problem there is that when you sort of drill down into the numbers, you can see that the big supporters, or the people who in the past who have built the largest US Treasury positions were Japan and the Bank of China. But if you look at the last year or so, Japan has increased its holdings somewhat. I think 1.3%. Now, it's not a lot, but then recently the government has been drawing down on its general account rather than issuing more debt, as it were, to fund its spending. China, on the other hand, you've now got to lump Hong Kong with it. Now, Hong Kong plus China own about exactly the same amount of treasuries as Japan, but they're reducing their involvement. They've cut their position by 3% over the last year. So this is not all that good. I think the other thing is that if you look at the quantity of dollars in circulation, it accounts for roughly half global money stock. I'm talking about narrow money, M1, as it were. So US M1 is roughly half the world's M1. Now, what this means is that, being the reserve currency and also used by everyone for commodity purchases in international markets and, as the medium for settling global trade, what's happening when when the Fed debauches the currency, increases the money supply, is they're not only transferring wealth from you guys as individuals in America, but they're also doing it to the foreigners. And this is not going down very well. And I think, particularly China, the Asian nations, they're out of the loop on this. And so their dollars are being debauched without them even being informed or consulted or offered any sort of, let's say, well, why don't you have a swap line and we'll take in some yuan and you can take in some dollars? Not even that. So I think that looking at the way in which foreign funding is going, it is actually retreating. Certainly in the last year and 18 months, they have cut their liquidity, their dollar liquidity. Deposits in correspondent banks have been reduced, and also holdings of treasury bills and that sort of short-term stuff have also been reduced quite sharply. So I don't see that side really keeping pace with the degree of funding. And indeed, it hasn't been so for some time. The other thing that's rather worrying is that if you look at the percentage of US Treasury held by, let's say, Friends of America, it's less than 10% of total ownership of dollars and dollar assets. So it's the 90% we need to worry about, not the friendly people like sort of, let's say, oil exporting nations in the Middle East who routinely go and buy dollars and invest in US Treasuries. Offshore insurance companies in the Cayman Islands and elsewhere who routinely buy US Treasury debt. These are small beer. They really are, compared with the total. The big elephant in the room is portfolio investment. There's no doubt at all that outside the core friends of America, the ones who would hold reserves for strategic reasons, that 90% or so are in there for speculative reasons. The reason they hold the dollar is because they're making money out of your markets. Now, the moment that changes, that money is going. I can tell you, it'll just disappear. So we're talking about a real problem here. Now, why should it go? The reason that it could well go is that we see prices rising quite sharply. This is unexpected. We're told it's transient. But in fact, it's a consequence of all the money printing that's happened pre-COVID and also during COVID and so on and so forth. You debase the currency, you decrease its purchasing power, and that's basically what's happening. So the idea that this is a transient problem is, I think, going to be exploded as a myth. And fairly shortly, you're going to find pressure for interest rates to start rising. Now, we've already seen a little bit of jockeying on this story, with the Fed saying, well, prices are rising a bit more than we originally thought, and we will probably bring forth some tapering and so on and so forth. But unfortunately, that tapering is going in the wrong direction. I'll come back to that in a second. The real problem is that not only are prices rising, but they are rising at an accelerated rate. I mean, we've seen what's happened with European gas prices. I mean, they literally multiplied, 5-6 times in a matter of days. It's been really very, very dramatic. China has got virtually no coal to drive its power stations. They're out even buying Australian coal, having put an embargo on buying Australian exports. They are desperate. They're having to shut factories because of electricity power cuts. So there is a big global energy problem. And it is hardly surprising that now that we're all out from COVID, suddenly you have got problems. You have got supply problems. You have got logistics problems and all the rest of it. So prices are rising, and they're not going to stop rising. And the problem is, in this sort of circumstance, when people realize that prices are rising, what do? They change the relationship between the cash they own and the goods they buy. They reduce their cash and increase their purchases of goods. So that if you look at essentials, and this is really where it does matter, not the sort of luxury stuff or the expensive holidays and so on. But when you look at essentials, people will start buying essentials that they don't immediately need, that they wouldn't have bought ahead of time before. They're going to go into the market and they buy it, and they drive up those prices even further. The consequence of that is that interest rates will rise. Now, this matters because as far as foreigners are concerned, they see rising interest rates. That equates to falling bond prices, and it equates also to falling equity prices. So the 90% of dollar ownership by foreigners, which is inherently speculative, suddenly starts looking like it's going to leave the scene. And that becomes a major problem. We'll assume at this stage that it won't actually sort of all disappear, because what we're concentrating on is how is the deficit going to be funded. The only other big actor in this is, of course, the Fed. But the Fed has turned around and said, we intend to taper. We're standing by ready to taper if the conditions warrant and all the rest of it. But that's not going to work. The Fed basically has got to ensure that money is produced, and it'll be new money out of thin air, in order to subscribe for government stock. We've already run through the alternatives, if you like, in America, like the banks are tapped out, individuals are rushing out, they're spending their money on something else rather than on US treasuries. So, and the foreigners are likely to sell it. The Fed has basically got the whole caboodle around its neck. And I think this is going to be a huge problem. Now, the further problem with rising interest rates is that it increases the budget deficit for the government. It does this in two ways. Firstly, you see a downturn in economic activity, which means that tax revenues start falling. And the second thing is, of course, the mandated costs that the government faces, they start rising. So, 3 trillion rapidly becomes 4 trillion. And when you add in that at the moment, I think it's sort of around about 400 billion of interest charges, when you see that rising as well, you can rapidly see that suddenly this is a real problem. Forget the idea of investing in infrastructure, sort of repairing your, the potholes in your roads and putting in new highways. That's not going to happen. It can't happen. There is no money available for it. So the whole of the sort of Biden package, economic package, basically, is just going to go out the window. But this is a major problem. And not only that, but the reason that the Fed has been able to, or the Treasury rather, has been able to fund itself over recent decades is the long-term trend in interest rates has been done. Now, that really does help a government fund its deficit. When, on the other hand, the long-term trend is to rise, and we're going to see this really quite sharply. I mean, it's probably a bit bold saying it's a long-term trend, but we're turning the corner. We've hit zero. We're now going higher. Under those circumstances, it's going to get increasingly difficult for the US Treasury to fund its deficit. So, new fiscal year, new world, new way of operating. How it's going to be resolved is impossible to see. I guess that the only thing that can happen is that governments who have cooperated, and I'm talking about the central banks, if you like, you've got the Fed, you've got the ECB, you've got the Bank of England, you have got the Swiss National Bank, and you've got the Bank of Japan. I mean, you've got 5 guys in there basically running the world's money outside of Asia, and they will probably start taking in each other's laundry. They've got swap arrangements. Well, basically what that means is that the Bank of England, for example, can draw down on dollars to buy US Treasury debt. The US Treasury can draw down on pounds to buy UK debt. Now, this is all very inflationary. I mean, it just makes the inflation problem even worse. But given that A, there is no alternative that I can see, and B, the establishment does not seem to connect the quantity of money with the price effect down the road, it could well be that they try this in desperation. So the long-term funding outlook, I think, is deteriorating. I think it's getting very, very tricky. And I think that the problems that we have seen in terms of, well, the consequences of printing money is going to drive up interest rates and undermine markets. Now, the Fed, basically, we've had this conversation about the John Law syndrome before. This is exactly what John Law did 300 years ago. He printed money to buy South Sea shares, and it was a scheme which worked until it didn't work. And not only did the shares fall over, but also the currency fell over. And I'm afraid that's what we face again.
A couple of things, if we could circle back on things you touched on. One of the things you talked about was in the face of awakening awareness by ordinary people of all levels of the economy, that the currency, as we used to say here in the U.S., or as we like to say, a buck ain't worth what it used to be. When people catch on to that, there's a scramble for buying up of real things, including food, non-perishable food and supplies and parts and materials and everything else, because they'd rather own something that isn't going away than something that is shriveling away, and that's their fiat currency. And this becomes it seems like what you're saying is a self-fulfilling prophecy, in that it accelerates the price inflation of ordinary things and the scarcity of those things. Am I reading you correctly? We call that prepping, by the way. We interviewed you about 3 or 4 years ago, and then the title of the interview was "What Will You Hoard?" But talking about that phenomenon of people catching on and deciding that they'd rather own things than have paper funny money.
Yes, you're absolutely right. I mean, there are 2 things which drive the relationship between money, or let's say currency, to be more accurate, between currency and goods. I mean, the prices of goods and how that relationship changes. I mean, obviously, we know from the supply of product side, we assume that the value of money doesn't change. So, when we go out and buy something or we compare the price of something else, money is the constant. The change always comes from the other side. Now, people don't actually understand readily that the purchasing power of money changes. But it can change, and it changes for two reasons. First of all, there is the quantity of it. If suddenly, it's expanded by a quarter, the amount of circulating currency is expanded by a quarter or a half, then obviously it's going to have an effect on the purchasing power of each individual unit. It's going to reduce the purchasing power of each individual unit. But it's not the only factor. The most important factor is that people accept currency for the purposes of exchange of, let's say labor, which is what we do. We go out and work, we get paid in the currency, and we use it to buy the things that we don't make ourselves. It's the acceptability of that bridge between our labor and what we desire, what we need to sustain our life and to make us happy. It's that bridge, the currency, that really matters. So long as we have faith in that currency, that it will discharge that function, there isn't a problem. You can increase its quantity, and okay, it loses purchasing power, but we'll still use it. But there comes a point where when the purchasing power of the currency starts going down, and you notice that the prices of everything are beginning to rise. Now, we're not talking 2%, who cares for 2%? You don't get out of bed for 2%. But if suddenly you're seeing things rising because they're not available, and you see them rising, say, because, the price of energy has doubled. In Europe, gas prices, I'm talking not petrol, but sort of gas for cooking and heating. They have just gone off the charts in the last month. It's extraordinary. They've gone up, sort of 500% or something. It's just spiked up. And so we know that we're coming into winter where there's going to be shortages of this, that, and the other thing. We know that we've had carbon dioxide shortages. Why? Because carbon dioxide is a byproduct of, dealing with sort of waste. And you use energy to extract the carbon dioxide, and extracting the carbon dioxide with expensive energy is just completely uneconomic. So plants are shut down. So the result is no carbon dioxide for fizzy drinks, for food packaging, and all these things we take for granted. So what happens? There's less food on the shelves. And there's less beer there, tin beer. So what do? We go to the supermarkets and we buy things which we don't actually need now, but we know that we will need, let's say in the next week, 2 weeks, 3 weeks, whatever. Where you've got shortages, that just drives up prices even more. It exacerbates the shortages. And what happens to the prices? The prices go up more. So you can see that this dislocation that we're seeing, which is the consequence of logistics, whatever, this dislocation is making people go out and buy things to avoid having to pay higher prices or to avoid shortages later on. But the more they do that, the more prices rise. And the more prices rise, the more we get rid of cash in order to secure those things we definitely do need in the future. It can be, tins of tomatoes, it can be anything. It really doesn't matter what it is. Whatever floats your boat, you go and buy it, and you will pay more and more and more for it. So we suddenly see that we're moving towards a position where we're actually discarding currency, a pool of currency, if you like, that we have. Liquidity available at any one time. We're discarding that in return for goods. Now, if you discard it totally, then obviously it loses all its purchasing power. I'm talking about not just the individual, but everybody. If everybody catches on, and we're talking about a mass move, if everybody thinks that, goods are so much more valuable than cash currency, then cash currency loses eventually all its purchasing power. And it can be quite a rapid process. As rapid as it takes for us to run out to the shops and get rid of the stuff. So this is a very serious situation. And how do you stop it? The only way to stop it is to do two things: to raise interest rates sufficiently to make people think, now, hold on a minute, I'm better off actually having money on deposit in the bank, earning interest, than actually rushing out and trying to buy things that are probably not on the shelves anyway. The other thing you have to do is you have to stop printing the stuff. You have to stop issuing it, which basically means that governments have got to stop spending money over their revenue. And then there's the third thing you might have to do, and that is you might have to introduce some other form of stabilizing it, which encourages the public to accept that far from something which is going down the toilet, your currency actually is definitely being stabilized. And that's something usually is you tie it to a metallic money like gold or silver. So you've really got to, the first two things you must do: raise interest rates, stop printing money. The third thing you might be forced to do, and that is to introduce some form of gold standard. And that's got to be credible if you do it. So that's roughly where we are. Now, we've been talking about this, I think, over the last, 3 or 4 years on your show. And, it's finally arrived. And I can understand that people are sort of confused seeing what's going on. But I think the answer is quite simple. We're seeing the dislocations from government intervention, from the changes that are being brought about particularly by COVID. We're seeing the debauchement of the currency beginning to affect us. We see that the economy starting, and this is another interesting thing, when the economy sort of gets back into some sort of swing after all the shutdowns, it's wrong to think, as governments obviously thought, that you just carry on where you left off. No, we've, 18 months later, our views and outlook on life and our desires and all the rest of it have changed. They have changed very much. So the result is that the production, which might have been appropriate 18 months ago, is no longer appropriate today. So this is why you've got shortages and why you've got surpluses of other things. And of course, on top of that, we've got this supply chain disruption, which is not going away in a hurry at all. That's going to continue, I think, well into next year. So this is where we are. And I think that anyone who is a bit confused, just think in terms of what happens. What happens when the money goes down? History also tells us this is the case. When you get an inflation of a currency, usually something goes wrong. It's not necessarily, the people don't actually sort of see the currency, because they don't understand money. But what they do understand is when it coincides with something like a bad harvest. I'm going way back. In fact, this happened in 1124 in this country under Henry I. There was a bad harvest after the moneyers, who were the people who produced or minted silver coins on behalf of the crown all around the country. The moneyers were debasing the coinage. They were, putting base metals in the coins. Now, the extra circulation of the currency, which of course they pocketed and then spent, meant that the purchasing power of the silver coinage at the time diminished. So this coincided with a bad harvest. A bad harvest basically meant that prices in these debauched shillings just went through the roof. We face exactly the same situation now. It's this sort of, when you're down, something comes along and kicks you, and that's certainly the problem, I think, with debauched currencies. And that's all we're seeing. That is exactly what we're seeing.
You mentioned along the way also about the necessity of authorities to raise interest rates, but isn't that, can you talk about what the knock-on effects are about the snowballing federal debt? And then secondly, the impact on these markets that are supposedly in the bubble of everything, bonds, stocks, real estate?
It's quite simple. If you look at bonds, they're valued at on the basis that interest rates are zero. Overnight interest rates are 5 basis points if you want to lend your money to the Fed via a repo, for example. if that rises to reflect the falling purchasing power of the dollar, it's not going to be a question of just rising, say, to 0.5% or 1% or even 2%. We're looking at something that is actually far more serious. I would expect interest rates to rise quite rapidly once they start rising, and I wouldn't be surprised to see them going over 10%. Now, that is a horrific thought in the current circumstances. So if you own US Treasury bonds or corporate debt, you've got to think what that does to the value of that debt. I mean, obviously, it kicks it in the teeth. If you own equities, you've got the same problem. Equities are valued on the basis that bonds are yielding close to nothing. That being the case, then, quite simply, equities will collapse. It's the bubble will be pricked. All financial assets will suffer that fate. If you look at residential property, the extent to which residential property is financed by mortgage finance with floating rates as opposed to fixed rates, that becomes a huge problem. Where mortgages have got to be renewed at the new rates, that's going to be a big problem. Where new buyers come into the market, the availability of affordable mortgages, that becomes a problem. So what happens to property prices? They go down. We've talked before about the effect in a real hyperinflation on property prices. I've mentioned the situation in Germany, where in Berlin you could have, in 1923, you could have bought a house for $100. Why $100? Well, $100 was actually slightly less than 5 ounces of gold. That's what you were paying. In paper marks, it would have been a few trillion, I guess. So you could argue that the price of property rose, but basically it didn't. What happened was the currency went down, and the currency going down impoverishes not only the people at the bottom of society, but also the middle classes. When you wipe out the middle classes, then all the assets which they value go down in value as well. It's not a question of finding a hedge, as it were, because everything goes down. The only reason that any assets went up in Germany was because Germany was able to export and earn foreign exchange, which became a lot more the currency, if you like, internally in Germany, displacing paper marks to quite a significant degree. So the economy worked. And I guess the same is true in Venezuela today. I don't know. I haven't been to Venezuela. I haven't seen what the situation is on the ground, but people are still surviving despite there being no currency. In effect, no currency. So dollars must be circulating on the black markets and all the rest of it. It's been like that in Argentina for almost ever. Those tangible assets go down. Now, the key to surviving in this situation is to have gold and silver, because they will be sought by anyone who wants to have some stability, who wants to preserve the real value of their wealth. So gold and silver are vital, and you can use gold and silver to acquire the assets which you need, or you decide that you may need after the dislocation is over. The dislocation may last. If governments continue, the dislocation could last for some time. If, on the other hand, governments stand back and can't do anything about it, and people sort it out themselves, then I think the dislocation is an 18th month wonder, no more than that. What emerges as credible currency after that, of course, is a completely different subject. But until that bridge is crossed, then gold and silver are the only things that you can really use, which will be recognized as money by anyone else. It's the unwinding, if you like, of Gresham's law. They'll come back into circulation.
The one thing I wanted to follow up with you about is this sense that I've gained as a retail bullion dealer over the last month or so, especially the last 2 weeks, anticipating, it seems many people calling me are anticipating convulsive events this month, October, this quarter, next quarter. It's as though this pressure that's been building for years, as we've been speaking for the last half a decade or more, is coming to a head. And what I'm trying to report is that it seems to be getting more mass awareness and this sort of grassroots concern on the part of ordinary people. Now, Rick Rule, who we interview often, reminds us that still now, today, we have less than 0.5% of anyone's investments altogether in natural resources, which includes precious metals and precious metals related equities. So still, the popular mindset is 99.5% not wakened yet. But I'm just seeing of the 0.5% who are calling me with increasing frequency that people are urgently concerned about what's about to happen, what's about to come. A lot of what you've talked about are major themes that are coming to a head. You even use the terminology, we're seeing it play out now. Any reflections you may have on this popular awakening? Because you've talked with us about that for some time. It's like when the common man on the streets realizes it's not prices going up, it's the currency being destroyed in his own pocket, in his own bank account, et cetera. So can you give us your perspective on this mass awakening that seems to be this mood shift, this popular awakening seems to be happening?
Yes, I mean, I think it's very much early stages. I mean, you and I will talk to like-minded people, and so we will see this, I think, before it's more evident in wider circles. But that said, certainly, this is the beginning of the end, if you like, of fiat currencies. I have no doubt about that whatsoever. And the thing that is so important in this is to understand why interest rates are going to rise and why interest rates are going to undermine financial assets, and why, by continuing to rise, they will also undermine physical assets. And we're talking about everything from residential property to the values of businesses and so on and so forth. I mean, even the values of things like farmland, you sort of think, well, when the world comes to sort of an end, if you've got a farm, you're okay. Well, maybe if you know how to farm, but the value of farmland in this situation, I mean, that goes down as well. Everything goes down. I mean, some things more than others. Some things go to real zero. It's a process that is beginning, as I say, and I think the next stage in it is a more wide understanding that there is something wrong with the money. I think that's the next thing we need to watch out for. I mean, as you rightly say, people are uneasy, but they don't really know why. So it's an education process, and I think it's a self-education process which is evolving. But of course, the other thing about October, it's the anniversary of the October crash. I mean, coming up this week, literally, or next week, because I think it was October the 14th, 1987, the whole thing fell apart.
I thought you were talking about 1929. Now you caught me up. Okay.
Well, you got that as well, yes. And the other thing about 1987 is that, if you're really of a suspicious or superstitious mind, in years, it's a Fibonacci number. It's 34 years since it happened, So, Elliott Wave people will say, well, it was going to afterwards they'll, not before necessarily, but afterwards they'll say, well, of course, it was absolutely on the button. 34 years, Fibonacci number. So you can see that there's a bit of mythology that you can feed into the uneasiness that there is around at the moment. And I think that will develop into increasing knowledge. And one of the things that I think is making people more knowledgeable about money than at other times this has happened, I think, is the invention of cryptocurrencies. I mean, the whole reason why you run out and buy Bitcoin or Ether or whatever it might be is because you understand that there is a limited supply of Bitcoin, like it's capped, yet you understand that central banks will print as much currency as they want. There's no limit to what a central bank will do. Therefore, the price of Bitcoin measured in the central bank's currency has only got one way to go goes up. And we've seen it go from, 16 cents to, well, currently, I think, with the time of speaking, something like $53,000. I'm not going to comment on whether it's money or whatever. But the main point about it is that it has educated millennials about money, at least to some degree. And that's the important thing. And I think what it means is that the awakening of people about what's going on and where it is going is likely to be more rapid than it would otherwise if we hadn't had cryptocurrencies. And the other important thing, I'm sure this is a question which will be in your viewers' minds, and that is, well, aren't central banks going to replace a failing currency with a new digital currency? Well, the problem there is that, well, there are many problems actually, but I mean, one obvious problem is that before you introduce a digital currency, you've got to be very careful how you do it and why you do it, and you've got to be really sort of confident in the technology. I'm talking about a government department now thinking this. You've got to get it through all the committees, you've got to get it through the politicians and all the rest of it, and you've got to satisfy them. And so this is not something that can be done as an emergency operation. It is something that you would expect to take 10 years to come in. And the other thing, of course, is that digital currencies bypass the banks. What have the banks got to say about it? I mean, at the moment, they've been sort of sitting back and not really saying anything, I presume, because they're not that worried about it yet. But, if you and I are going to be dealing direct with the central bank, then we don't need to deal with, with our local bank branch, who probably doesn't want to see us anymore anyway, because we're too expensive to deal with. So, and then the other thing is that, the idea is it's all very spooky. So it's not necessarily going to be easily accepted by the public because we're suspicious that the central bank is going to tell us how we spend our money. So you can see that there are all sorts of things which, are going to make this a very difficult thing. Even assuming it comes through, the idea that a central bank digital currency will replace existing dollars, you can forget. It is additional to money in circulation, because otherwise, we're going to just take money out of circulation, replace it with this. That is not the intention at all. Everything that I've read, the intention is to have another form of stimulating the economy, and it'll be targeted and so on and so forth. And the other thing is that at least the central bank and the authorities will know exactly who's spending what. It'll make tax collection a lot more efficient. They'll say that they can crack down on crime. They've got all these reasons for it. But one reason they don't have is to replace circulating currency with a new digital currency. No, it's going to be in addition. It must be, because you're going to cut out the banks for a start, and then create a crisis if you start contracting the amount of dollars in circulation. So that's an important point to recognize. So if we look in history, we can go back to the French Revolution, when the revolutionary government, and it was actually came in just before the revolutionary government, they introduced the assignat as a currency, and they couldn't resist issuing further tranches and further tranches. I mean, the John Law experience was sort of, in folklore at that stage, and there was huge resistance to the introduction of the assignat. Anyway, eventually it went ahead. And what happened? The assignat undoubtedly contributed to the French Revolution. I mean, people don't just sort of revolt for the hell of it. They don't revolt because they don't like their superiors. They revolt because they're bloody well starving. And this is what happened. This is when the assignat failed. So what did the Revolutionary Council then do? They introduced the mandat territoriaux. It's rather like a new digital currency coming out today. And within 6 months, that had gone, completely gone. But we're talking about an economy where spending was done, by cash notes, either specie or bits of paper. with a value written on them. So you had to go and get the bits of paper. You had to, physically, you couldn't do this with a sort of credit card or anything like that. It was a slow process disposing of falling money. And it took 6 months, basically, for the mandat territorio to just go exactly the same way as the as a former currency. So the idea that that's going to work, I think we can forget. History tells us quite clearly that it's just another form of printing money or printing currency, and it will go exactly the same way of fiat currency, which is going that way anyway. So I think we can forget digital currencies.
It's certainly, I don't think we can have a lot of confidence that reasonable timelines will protect us from rushed things coming in. We certainly have seen in the last 2 years, I don't want to get into the terminology, but let's just say things happening at warp speed that people think shouldn't have. But also that there's been claims by other analysts that in fact the central banks have been and the governments have been working for some time in readying and preparing digital currency, and that many steps and signs and signals are indicating, for example, the proposal that any transaction of over $600 needs to be completely tracked and reported by banks to the IRS. And the fact that the trend overall the past decades has been for less and less and less physical cash transaction as a proportion of all transactions in the economy. I even have to confess, we just came back from a week and a half team building trip with our team out of state. And in fact, every time that I tapped a card on a card reader rather than fishing out physical currency to pay for a purchase, I felt I'm part of the problem. This shift of our entire retail economy out of physical cash. We'd like to have you back again soon to talk about that snowball of runaway inflation and interest rates and what people can do about it. You've already given us tips, clues around that, about making sure that you're not short of the things that you need to live on, and also how to make sure that you, at least when you said that in a deflationary time everybody loses, it's just you can find ways to lose less than you otherwise, to not get completely wiped out. If people want to follow your work, where should they go, Alasdair?
GoldMoney.com, and hit the research tab, insights, and I publish an article every Thursday. I've just published one actually on this government funding situation. So anyone who was interested in what we were saying there might like to have a look at that article. And I do a market report on precious metals, focusing on precious metals, on Friday. So those are published in the afternoons, EST, on Thursday for the big article, and then for the market report, that's on Thursday. And the other thing is that we do offer a service whereby you can buy and store precious metals in vaults all around the world, to give you, sort of get some of your wealth, if you like, out of the fiat money system. If, like me, you think that's worth doing, then you might like to have a look at the website and see whether we can help you.
Alasdair, as always, on behalf of all of our viewers, and not the least of which is myself, grateful for your presence here on Liberty and Finance and giving us your studied perspective of the road ahead. It's certainly volatile times we are in, and heading into perhaps even greater volatility. We'd like you to continue to be there as a lamp holding guide for us along the way to help us see into the darkness. We appreciate your presence here, and just thank you for joining us on Liberty and Finance.
That was very much my pleasure, DK.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price, with personalized private service from one of the oldest and best companies in the business. 31 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded. For physical delivery, vault storage, or precious metals IRAs, excellent prices, privacy, and confidentiality. Pay by check, money order, ACH, bank wire, or Bitcoin. Satisfaction guaranteed. For fastest service, just call 1-888-81-LIBERTY. That's 888-81-LIBERTY. And either I or one of my sons and fellow brokers will call you back as soon as we can and understand your needs.